Gold just crashed 5% in a single day, and silver swung 12% in less than a week. If you're holding precious metals right now, your heart rate probably matches those price charts. But here's what the wealthy investors know that you do not. Volatility is not your enemy. It is actually your greatest opportunity to build serious wealth. Most people panic when gold drops or chase silver when it spikes, making the worst possible moves at the worst possible times. Meanwhile, a small group of strategic investors are quietly accumulating wealth through every market cycle, whether metals are soaring or tanking. The difference: they've mastered the patterns. In this video, I'm breaking down the exact strategies that work in bull markets, bear markets, and everything in between. You'll discover why dollar cost averaging might be costing you thousands, when to aggressively buy the dip versus when to hold back, and the crucial timing signals most investors completely miss. I'll show you how to position yourself for maximum gains while protecting your downside, regardless of what the market does next. Whether gold hits $3,000 or drops to $2,500, you'll know exactly what to do. This isn't theory. These are battle-tested strategies used by professional precious metals traders. If you're ready to stop reacting emotionally and start profiting strategically from gold and silver volatility, smash that like button right now and let's dive in. Hey everyone, welcome back to the channel. If you're new here, make sure to subscribe because we're diving deep into precious metal strategies that can genuinely transform how you approach this market. And if you've been following along, you already know we don't do surface level content here. We get into the real tactics that separate successful investors from those who are just along for the ride, getting tossed around by every price swing. So let's talk about what's really happening in the gold and silver markets right now. I want you to understand something fundamental that most people completely overlook when you see gold prices jumping around or silver having one of those wild days where it moves more in percentage terms than most stocks do in a month. There's actually a predictable pattern underneath all that chaos. The problem is that most investors are so focused on the noise, on the minute-to-minute price movements, that they completely miss the signal. They're staring at the trees and missing the entire forest. Think about the last time you saw gold drop significantly. What was your first reaction? If you're like most people, you probably felt a knot in your stomach. Maybe you thought about selling to cut your losses, or perhaps you froze and did nothing at all. And when gold is soaring, when everyone's talking about it and mainstream media is covering the rally, what happens then? That's when most people finally feel comfortable buying. Right at the top, right when the smart money is already starting to take profits. This emotional roller coaster is exactly what keeps average investors from building real wealth in precious metals. But here's the thing: volatility in gold and silver isn't random. It's driven by very specific factors, and once you understand these factors, you can actually predict with reasonable accuracy when volatility is likely to increase and when it's likely to calm down. You start to see opportunities where others see danger. You start to recognize patterns that repeat themselves over and over again throughout history, and most importantly, you develop a framework for making decisions based on logic and strategy rather than fear and greed. Let me break down what actually drives precious metals volatility, because this is where most people get it wrong. They think it's just supply and demand, or maybe they've heard that gold goes up when the stock market goes down. Those are oversimplifications that will cost you money. The reality is much more nuanced, and understanding this nuance is what gives you an edge. First, you need to understand the role of the US dollar. Gold and silver are priced in dollars on international markets, which means there's an inverse relationship at play. When the dollar strengthens against other currencies, it takes fewer dollars to buy the same amount of gold, so gold prices typically decline. When the dollar weakens, gold prices usually rise. But here's where it gets interesting. This relationship isn't always one-to-one, and there are periods where both gold and the dollar rise together or fall together. These anomalies tell you something important is happening in the global financial system, and they often present the best opportunities. Then you have real interest rates, which is the nominal interest rate minus inflation. This is absolutely critical, and most people don't pay nearly enough attention to it. When real interest rates are negative, meaning inflation is higher than what you can earn on safe investments like treasury bonds, gold becomes incredibly attractive. Why would you hold cash or bonds that are losing purchasing power when you could hold gold? This is why gold performed so spectacularly during the high inflation period of the late 70s and early 80s, and it's why we saw gold make new all-time highs recently when real rates were deeply negative. Geopolitical uncertainty is another massive driver. When there's a crisis, whether it's a war, a pandemic, political instability, or financial system stress, investors flee to safety. Gold has been the ultimate safe haven for thousands of years, and that's not changing anytime soon. Silver behaves similarly, but because it's also an industrial metal with significant uses in technology, solar panels, and electronics, it has an additional dimension to its price drivers. This dual nature of silver, being both a monetary metal and an industrial commodity, actually amplifies its volatility. When industries are booming and economies are growing, silver demand increases. When there's financial fear, its monetary aspect kicks in. This creates these incredible situations where silver can outperform gold by massive margins. Now, let's talk about market cycles, because this is where strategy really comes into play. Precious metals don't move in straight lines. They go through distinct cycles that, if you understand them, allow you to position yourself optimally. There's the accumulation phase, where prices are relatively stable or declining, and nobody's talking about gold and silver. This is actually when the smartest investors are buying. Then there's the markup phase, where prices start rising, momentum builds, and more investors start paying attention. This can last for years, with periodic corrections along the way. After that comes the distribution phase, where the rally is mature, everyone's bullish, mainstream media is full of stories about gold, and smart money is selling to the late arrivals. Finally, there's the markdown phase, where prices decline, sentiment turns negative, and the cycle starts over. The key to mastering volatility is recognizing which phase you're in and adjusting your strategy accordingly. During accumulation, you want to be aggressive. This is when you dollar cost average, when you take advantage of dips, when you build your position systematically. The problem is that this phase feels the most uncomfortable. Prices aren't exciting, there's no momentum, and you might feel like you're catching a falling knife. But this discomfort is precisely what creates the opportunity. If it felt easy and everyone was doing it, the profits wouldn't be there. During the markup phase, your strategy shifts. You're still buying on pullbacks, but you're being more selective. You're letting your winners run, and you're not chasing price spikes. This is when discipline becomes crucial, because FOMO, the fear of missing out, can cause you to make terrible decisions. You see silver jump 10% in a week, and you think you need to buy right now or you'll miss the boat. But experienced investors know that markup phases have plenty of corrections, plenty of opportunities to enter at better prices. Patience during this phase is what separates good returns from great returns. Distribution is where most people get destroyed, and it's where having a strategy becomes absolutely essential. This is when your neighbor who never mentioned precious metals suddenly wants to talk about his gold coins. When financial advisors who were dismissive of gold for years suddenly recommend it. When magazine covers feature stories about the gold rush. These are classic signs that you're near a top, and instead of buying more, you should be thinking about taking some profits. Now, I'm not saying you sell everything. Precious metals can be a long-term hold, and trying to perfectly time the top is nearly impossible. But taking some profits, rebalancing your portfolio, reducing your position size, these are smart moves during distribution. The markdown phase is psychologically brutal, but it's also where you set yourself up for the next cycle. Prices are falling, sentiment is terrible, people who bought near the top are selling at losses, and media stories focus on how gold is a bad investment. If you understand the cyclical nature of these markets, you recognize this as the early stage of the next accumulation phase. This is when you start building your position again, slowly and methodically. Let's get tactical now, because theory is useless without practical application. How do you actually implement a volatility smart strategy in real market conditions? The first thing you need is a framework for making decisions, something that removes emotion from the equation. I use what I call the 3-tier approach, and it's served me incredibly well through multiple market cycles. Tier 1 is your core position. This is precious metals you buy and hold for the long term, regardless of short-term volatility. Think of this as insurance and long-term wealth preservation. This might be 20 to 30% of your precious metals allocation, and you don't trade it. You don't sell it when prices spike. You don't panic when prices drop. It's just there, protecting you against currency debasement, financial system risk, and major economic disruptions. For most people, physical gold and silver in your possession or in secure storage makes sense for this tier. Tier 2 is your strategic position. This is where you take advantage of market cycles and major price movements. When you identify that you're in an accumulation phase, you're building this position. When you recognize distribution characteristics, you're reducing it. This might be another 40 to 50% of your allocation, and it's where you can generate significant returns by being patient and disciplined. This tier might include physical metals, but it could also include mining stocks, ETFs, or other leveraged ways to gain precious metals exposure. Tier 3 is your tactical position. This is where you take advantage of short-term volatility, and it requires the most active management. When gold drops 5% in a day on nothing but technical selling or margin calls, that might be an opportunity to add to your tactical position. When silver spikes 15% in a week on a short squeeze or momentum buying, that might be a chance to take some profits. This tier might only be 20 to 30% of your total allocation, and you should be comfortable with more frequent trading and higher risk. The beauty of this three-tier approach is that it gives you exposure to precious metals in a way that matches different market conditions and risk profiles. Your core position means you're never completely out of the market, so you don't miss major moves. Your strategic position allows you to capitalize on multi-year cycles, and your tactical position lets you take advantage of volatility without putting your entire portfolio at risk. Now, let's talk about specific indicators you should be watching, because having a framework is great, but you need actual signals to make decisions. The gold to silver ratio is one of the most useful tools for precious metals investors, and most people don't use it properly. This ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged somewhere around 50 to 60. Meaning it takes 50 to 60 ounces of silver to equal the value of 1 ounce of gold. But this ratio fluctuates wildly, sometimes going above 80 or even 90, and sometimes dropping below 40. When the ratio is very high, above 75 or 80, it's telling you that silver is cheap relative to gold. This has historically been an excellent time to favor silver over gold in your purchases. When the ratio is very low, below 50, gold is relatively cheap compared to silver. Now, this doesn't mean you blindly trade based on this ratio, but it's an excellent tool for deciding how to allocate new capital between the two metals. If you're in an accumulation phase and the gold to silver ratio is at 85, that's a strong signal to focus your buying on silver. Real interest rates, which I mentioned earlier, are another critical indicator. You can track this by looking at the yield on Treasury inflation protected securities, or TIPS. When these yields are negative, gold tends to perform well. When they're significantly positive, gold faces headwinds. Right now, understanding where real rates are and where they're likely headed based on Federal Reserve policy and inflation trends can give you a huge edge in timing your precious metals positions. The Commitment of Traders report is a tool that professional traders use, but retail investors often ignore. This report shows you the positions of different types of traders in the futures markets. When commercial hedgers, who are typically the smart money, are heavily long gold, that's a bullish sign. When speculators are extremely long and commercial hedgers are short, that often signals a top is near. Learning to read this report takes some practice, but it's publicly available information that can significantly improve your timing. You also want to watch the US dollar index, which measures the dollar against a basket of other currencies. A rising dollar typically creates headwinds for gold and silver, while a falling dollar is supportive. But remember, this relationship isn't perfect, and there are times when both move in the same direction, which usually indicates something unusual is happening that's worth investigating. Mining stocks deserve special attention because they can amplify your returns during bull markets, but they also amplify losses during declines. The performance of gold and silver mining stocks relative to the metals themselves tells you a lot about market sentiment. When mining stocks are outperforming the metals, it indicates strong bullish sentiment and risk appetite. When they're underperforming even as metal prices rise, it suggests skepticism and weak sentiment. And when mining stocks are getting crushed while metal prices hold up, that's often a sign of extreme pessimism and a potential buying opportunity. Let's address some common mistakes that destroy returns for precious metals investors. Because avoiding these mistakes is just as important as implementing good strategies. The biggest mistake I see is treating precious metals like stocks and trying to day trade them based on charts and technical indicators alone. Yes, technical analysis has its place, but precious metals are fundamentally different from stocks. They're currencies, they're commodities, they're insurance. They respond to macro factors that don't fit neatly into chart patterns. Another massive mistake is going all in at the wrong time. I've seen people take their entire life savings and dump it into gold or silver after a big rally, convinced that prices are going to the moon. Sometimes they get lucky and prices continue higher. More often, they buy near a top and then suffer through a brutal correction that tests their conviction. The three-tier approach I described earlier prevents this mistake by forcing you to build positions over time and maintain diversification within your precious metals allocation. Ignoring storage and security costs is another error. Physical precious metals need to be stored safely, and that costs money. Whether you're paying for a safety deposit box, a home safe, or professional vault storage, these costs eat into your returns. You need to factor them in when calculating whether a particular precious metals investment makes sense. For smaller positions, these costs might make ETFs or mining stocks more practical than physical metal. Then there's the mistake of neglecting the tax implications. In many jurisdictions, precious metals are taxed as collectibles, which means higher capital gains rates than stocks or bonds. Understanding the tax treatment in your specific situation is crucial for calculating real returns and making smart decisions about when to take profits. Let me share a real example of how these strategies play out in practice, because concrete examples make abstract concepts much clearer. In early 2020, when COVID hit and financial markets went haywire, gold dropped sharply alongside everything else. People were panicking, selling everything for cash, and precious metals got caught in the liquidation. If you understood market dynamics, you recognize this as forced selling, not a fundamental rejection of gold's value. In fact, the conditions were perfect for gold: massive monetary stimulus, collapsing real interest rates, unprecedented uncertainty. Smart investors used that dip to add to positions, and gold proceeded to rally over 30% that year, hitting new all-time highs above $2,000 per ounce. Silver's move was even more dramatic. It fell to around $12 per ounce in March 2020, then rallied to almost $30 by August. That's more than a 150% gain in 5 months. But here's the thing: if you panicked and sold during the March crash, or if you waited until silver was already at $25 before buying because you finally felt confident, you missed the majority of that move. The investors who profited were those who had a framework, who understood that the March selling was irrational, and who had the courage to buy when it felt most uncomfortable. Another historical example worth examining is the period from 2001 to 2011. Gold started that decade around $270 per ounce and peaked above $1,900. That's a gain of over 600%. But the journey wasn't smooth. There were multiple corrections of 20 to 30% position along the way. Investors who panicked and sold during those corrections missed the subsequent rallies. Those who understood they were in a secular bull market used those corrections to add to positions and were rewarded handsomely. Silver during that same period went from around $4 per ounce to nearly $50. That's over 1,000% gain. But again, the path was volatile. There were heart-stopping drops that shook out weak hands. The investors who made life-changing returns were those who had conviction based on understanding the fundamentals, who had a plan for managing volatility, and who stayed disciplined through both the rallies and the corrections. Let's talk about position sizing, because this is where a lot of theoretical knowledge breaks down in practice. You might understand everything I've discussed so far, but if you don't know how to properly size your positions, you're going to make costly mistakes. The general principle is that your position size should be inversely related to the volatility of the asset and directly related to your conviction and time horizon. For your core position, the one you're holding for long-term wealth preservation, you might allocate 5 to 15% of your total investment portfolio to physical gold and silver. This percentage depends on your age, risk tolerance, and overall financial situation. Younger investors with stable income and long-time horizons might be at the lower end. Older investors concerned about currency debasement and financial system stability might be at the higher end. For your strategic position, the amount you allocate depends on where you are in the market cycle. During clear accumulation phases, you might build this position to represent another 10 to 20% of your portfolio. During distribution phases, you reduce it significantly or eliminate it entirely. The key is that this position size changes based on market conditions, and you have predefined rules for when and how much to adjust. Your tactical position should be sized small enough that even if you're completely wrong, it doesn't materially impact your financial situation. For most people, this means 2 to 5% of their portfolio at most. Remember, this is the position you're actively trading, taking advantage of short-term volatility. The win rate on these trades is never 100%, so you need to size them in a way that allows you to take multiple shots without catastrophic losses. One technique that works exceptionally well for managing precious metals volatility is the use of trailing stops combined with position scaling. When you enter a position during an accumulation phase, you start with a smaller size. As the price moves in your favor and confirms your thesis, you add to the position at higher prices. This might seem counterintuitive because conventional wisdom says to buy low and sell high, not to keep buying as prices rise. But in trending markets, this approach ensures you have your largest position during the strongest part of the move. The trailing stop protects your gains. As prices rise, you adjust your stop loss level higher, locking in profits while still allowing the position room to breathe. If the trend reverses and hits your trailing stop, you exit with a profit. If it continues higher, you continue raising your stop and potentially adding to the position. This technique requires discipline and a systematic approach, but it's incredibly effective for capturing major trends while protecting against sudden reversals. Understanding seasonal patterns in precious metals can also give you an edge. Gold tends to be stronger in certain months of the year and weaker in others. Historically, gold has shown strength in January and February, weakness in March and April, strength again from August through the end of the year. These patterns aren't guaranteed, and they can be overridden by major fundamental factors, but they exist because of predictable flows related to jewelry demand, particularly from India and China, and year-end portfolio rebalancing by institutional investors. Silver has similar seasonal tendencies, though they're slightly different from gold. Understanding these patterns allows you to time your accumulation and profit-taking more strategically. If you're building a position and it's approaching a seasonally weak period, you might wait for better prices. If you're looking to take profits and you're entering a seasonally strong period, you might hold a bit longer to capture additional gains. The relationship between precious metals and other asset classes is another crucial consideration. Gold often moves inversely to stocks, particularly during crisis periods. Understanding this correlation allows you to use precious metals as a portfolio hedge. When stocks are overvalued and vulnerable to a correction, increasing your precious metals allocation provides protection. When stocks are in confirmed uptrends and precious metals are weak, you might reduce precious metals exposure and allocate more to equities. The correlation between precious metals and commodities more broadly is also important. When commodities are in a bull market, precious metals usually participate. When commodities are weak, precious metals often struggle as well, though their monetary characteristics can sometimes override this relationship. Tracking broad commodity indices gives you another data point for assessing the overall environment for precious metals. Central bank behavior is something you absolutely must monitor if you're serious about precious metals investing. Central banks are major buyers and sellers of gold, and their actions impact prices significantly. When central banks are net buyers, adding to their gold reserves, it's a bullish sign. When they're net sellers, it creates headwinds. In recent years, central banks in countries like China, Russia, Turkey, and India have been aggressive buyers of gold, reducing their dollar reserves and diversifying into hard assets. This trend has provided fundamental support for gold prices. Central bank monetary policy more broadly affects precious metals through its impact on interest rates, inflation, and currency values. When central banks are printing money aggressively, keeping interest rates low, and tolerating higher inflation, precious metals thrive. When they're tightening policy, raising rates, and fighting inflation aggressively, precious metals face challenges. Understanding the current policy stance and where it's likely headed is essential for positioning yourself correctly. The mining sector deserves its own discussion because mining stocks can provide leveraged exposure to precious metals prices, but they come with additional risks and considerations. When gold prices rise, mining companies see their profit margins expand dramatically because their costs are relatively fixed while their revenue per ounce increases. This operational leverage means a 20% rise in gold prices might result in a 50 or 100% rise in a mining company's earnings and stock price. However, mining stocks also carry company-specific risks that physical metals don't have. Operational problems, management incompetence, political risk in the countries where they operate, labor strikes, environmental issues, and acquisition mistakes can all destroy shareholder value even when metal prices are rising. This is why, if you invest in mining stocks, diversification across multiple companies and jurisdictions is crucial. There are different categories of mining stocks to consider. Major producers are large, established companies with operations around the world, lower risk, and more stable cash flows. Mid-tier producers are smaller but still established, often with more growth potential but higher risk. Junior miners are exploration and development companies that don't yet have producing mines. They're extremely high risk but can deliver massive returns if they make a major discovery or successfully bring a mine into production. For most investors, a mix of major and mid-tier producers makes sense for the strategic portion of their precious metals allocation. Juniors are appropriate only for the tactical position, and only if you have the expertise to evaluate geological potential, management quality, and development risk. Many investors have lost fortunes in junior mining stocks by treating them like lottery tickets rather than businesses that require careful analysis. ETFs and other paper forms of precious metals exposure are popular because they're convenient and liquid. You can buy and sell them instantly in your brokerage account without worrying about storage, insurance, or security. However, they come with their own considerations. Some ETFs are backed by physical metal held in vaults, which provides direct exposure to price movements. Others use futures contracts and derivatives, which can result in tracking errors and underperformance relative to the metal itself. Understanding the structure of any ETF you invest in is crucial. Read the prospectus, understand what you actually own, know whether you have any claim to physical metal or just a contractual right to the value of metal. For long-term core positions, physical metal in your possession or an allocated storage where you have direct ownership is generally preferable. For strategic and tactical positions where you're trading actively, ETFs can be more practical. As we move toward the conclusion, I want to emphasize the importance of continuous learning and adaptation in precious metals investing. The market evolves, new factors emerge, and strategies that worked in one environment might need adjustment in another. The principles I've outlined in this video are timeless, but their specific application requires you to stay informed and think critically about current conditions. Develop your own watch list of indicators and metrics that you review regularly. This might include gold and silver prices, the gold to silver ratio, real interest rates, the dollar index, mining stock performance, and commitment of traders' data. Set aside time weekly or monthly to review these indicators and assess whether they're confirming or contradicting your current positioning. This disciplined approach prevents you from making impulsive decisions based on short-term noise while keeping you responsive to genuine shifts in the market environment. Build relationships with other serious precious metals investors. Join forums, attend conferences, follow reputable analysts who have proven track records. The precious metals community is full of passionate, knowledgeable people who are willing to share insights and perspectives. You don't have to agree with everyone, but exposure to different viewpoints helps you refine your own thinking and avoid blind spots. Keep detailed records of your trades and investment decisions. Write down not just what you bought and sold, but why you made those decisions, what your expectations were, and how things actually played out. This creates a feedback loop that allows you to learn from both successes and mistakes. Over time, you'll identify patterns in your decision making, recognize your strengths and weaknesses, and continuously improve your approach. Remember that precious metals investing is a marathon, not a sprint. The greatest returns come to those who have the patience and discipline to hold through multiple cycles, who have the courage to buy when others are fearful, and who have the wisdom to take profits when others are greedy. Volatility will test you, shake your conviction, and tempt you to abandon your strategy. But if you've done the work to understand these markets, if you have a sound framework, and if you stay disciplined, that volatility becomes your friend rather than your enemy. The wealth building potential in precious metals is enormous, but it's realized over years and decades, not days and weeks. Approach this market with respect, with humility, and with a commitment to continuous improvement. The strategies I've shared in this video are the result of countless hours of study, years of experience, and plenty of expensive mistakes along the way. You can accelerate your own learning curve by applying these principles systematically and thoughtfully. If you found this deep dive valuable, make sure you're subscribed to the channel because we're regularly publishing content that goes beyond surface level analysis to give you actionable strategies for building real wealth. Hit that notification bell so you don't miss future videos. Drop a comment letting me know what specific aspect of precious metals investing you want me to cover next. Are you interested in learning more about mining stock analysis, comparing different storage options for physical metals, understanding how to read commitment of traders' reports, or diving deeper into the macroeconomic factors that drive precious metals prices? Let me know and I'll create content around the topics you find most valuable. Share this video with anyone you know who's invested in precious metals or thinking about it. These are strategies that can genuinely make a difference in investment outcomes, and the more people who understand how to navigate these markets intelligently, the better. If you want to support the channel beyond just watching, consider joining as a member for exclusive content and direct access to our community of serious precious metals investors. Thank you for investing your time and watching this comprehensive guide. I genuinely appreciate you being here, and I'm committed to continuing to provide the highest quality educational content on precious metals investing. Remember, master the volatility and you'll master the market. Stay disciplined, stay informed, and I'll see you in the next video where we'll continue building your precious metals knowledge and strategy. Until then, invest wisely and protect your wealth.